Have you ever tried walking across a balancing beam and you just kind of lose your balance a little bit, but you kind of hold steady and keep making your way across the balance beam, but in the end, you end up falling off because your balance isn't that good and you're not a balancing person. You're not the type of person that really does that type of thing. Well, that's exactly where the market's at right now. It's kind of at this like balancing point to where it doesn't really know the direction it wants to go. We could be making higher lows and higher highs and start the ascent back to the high side after this correction and it could be over, or we could continue downward and this is all just a little bit of a snapback, a little bit of a bear flag forming, and there's more pain ahead. We really don't know. We're on the balancing act and we're kind of flowing back and forth right now. Haven't really fell off the balancing beam yet, but that's kind of where we're at right now. And in this video, I want to just give a weekly preview of the upcoming week. I'm going to talk about the economic calendar. I'm going to talk about the overall markets. I'm going to talk about the QQQ, the SPY, talk about what I'm seeing in those. And then at the end of the video, we'll get into some watch list items, some good trades that I see that have a lot of potential if they play out, and a lot of other ones that could actually be really good trades right now. So let's get into it. Here we see we have the economic calendar up, and Monday is a nothing burger, Tuesday is a nothing burger, and then we got durable goods orders month over month expected to be massively down. And then the big one we have on Thursday at 8:30 in the morning is going to be your GDP growth rate quarter over quarter, and it's supposed to be slowing down, from 3.1% the prior month or prior quarter down to 2.3% this quarter. And we're kind of already know that GDP is going to slow down and it's forecasted to slow down based on first Atlanta Fed, and now after the Fed meeting, the FOMC meeting this past week, they also said, Fed Chair Powell also said that they do expect, and they have revised lower our GDP growth. So something that could be an issue, but at the same time, we're just kind of going through this time with tariffs and everything, and no one really knows how it's going to play out on the other side. So once we get more clarity on that, then obviously, GDP could come back. We just don't know where we're going right now. And that is why the markets are down in correction territory, because there's so much uncertainty right now, because no one really knows, where we are going. And by the way, if you enjoy these types of weekly previews to get you started for the week ahead, please like, follow, subscribe. It really helps the channel. It really helps me as a creator, and it really lets me know that you want more of this type of content. If you don't want more of this content, then I won't do this for everybody. I'll just do this for the people in my community, obviously. So moving on Friday at 8:30, we have core PCE price index month over month. We have personal income month over month, and we have personal spending month over month. So this is actually looking to be a mixed bag. So we have, basically in line from last month of PCE. And then we have a big drop in personal income month over month of about 50 basis points there. And then we have a big increase in personal spending month over month forecasted from negative 2% or negative 0.20%. Sorry, negative 20 basis points, will go like that, up to 60 basis points to the positive side. So that'd be pretty bullish if they came in and beat that 60 basis point forecast. And it would also be bullish if they came in and beat the personal income month over month, and then just stayed in line with the PCE or beat it. So that's the economic calendar. Let's get into some charts. So the QQQ here, we're looking at a monthly. We'll go monthly, weekly, daily for the QQQ, and then the SPY. And then, like I said, we'll get into some of the other things that we're looking at. Watch list items, possible trades we are really looking to enter this week. So you see we have this bullish channel since about November 2022, and we just consistently have come up and down and really build out this really nice bullish channel. While doing that, subsequently we have built out a really nice Williams consolidation box. Williams consolidation box is using the Williams percentage range, and it's essentially my personal strategy that I created to kind of tell me, to give me another indicator on bullishness and bearishness. If we were up here and we create this bullish Williams consolidation box, as you see, and we continue to go sideways up here above the, let's call it the -40 line, as long as we stay within this box up here, we continue to rise higher. Subsequently, on the bearish side, we build this bearish Williams consolidation box, and as long as we stay within this confines of this box, we continue to the downside. So this really helps you on a higher time frame, and it's the strategy that I kind of found, created, figured out, right, to really help me predict markets and where we're going in the longer term. So beginning of bull market, we get the bullish cross, and then we're up and away, and we stay in the Williams consolidation box, and we're good. And then obviously now we have broken down out of that Williams consolidation box like we did in the past here in 2022, and then it was nothing but max pain, as we see here. Now, I'm not saying that this is what it's going to be this time around. Essentially, where we are right now in this 2022 comparison would be if we drew a bullish channel, right? We'd be right there. And essentially where we are is going to be right here. We are on this candle with this arrow is pointing to right here. We're on this candle, okay? And with this candle, right, we see that we broke down underneath the bullish channel, and then we wicked back up into the bullish channel. Now, when this happened here, it was just, yep, we did that for the month of January, and then right after that, we collapsed, right? Could be the same thing here, right? Could come down to this bottom, wick up, and then the next month we just collapse lower, and then we go down here, and we go all the way down to $400-ish on the QQQ, and then we curl back up, and then we get and start a new bullish uptrend. That is definitely a possibility here, just with everything we're seeing in the Williams consolidation box and it being broken down. It's definitely not a good sign. But, we still have a week and some change in the month of March, and I do believe that, we will start having a more bullish uptrend over the next few weeks, and that could bring us, closer up here to the Williams consolidation box and keep us above this -40, which at that point, maybe it would just be a deeper Williams consolidation box made. But again, this could be a leading indicator and has, forecasted in the past bear market starting. So if we get confirmation and we stay below the Williams consolidation box leading into April 1st, well, that's definitely not going to be a good sign for markets, right? But as long as we stay within this bullish channel as well, that is a good sign, because we saw last time with the Japanese trade crisis, that was right here. We came all the way down, and then we wicked hard, and then we bounced all the way back up, right? I think this time's a little bit different because there's more recession fears and everything. But at this time as well, back in October 2023, you had that scare, whatever it was, can't remember. And, we went down to the bottom, and then we bounced back. So, yeah, we're just kind of playing a game of wait and see here. And we really just need to not get too bullish, not get too bearish. Like I said, stay on that balancing beam as long as we can before potentially falling off or making it to the other side. Making it to the other side meaning, hey, this was just, some pain, and now we're back on the up and up, back to the bull run that we're still in as of right now. But this bull run is teetering back and forth on the balance beam and kind of getting close to possibly falling off, in which we would have a bear market. And that would mean our next levels are 440 and then 400 for, I would say, max pain down here to previous highs, previous resistance of the last bull market. and then the last retest. So basically, we had our highs of the last bull market in November 2021. Then we had our bear market. Then we retested the bull market highs. We rejected, and then we broke through, and then retested, and then broke through. And then we've been on the up and up since. So again, we're still on the balance beam, and we just have to see where things play out. Again, one last time, you know, if we do continue and close outside this Williams consolidation box, then I will be way more bearish than bullish, 100%. I already am, leaning on the side of caution. I do believe this could just be a correction of 10 to 20%, but at the same time, this just isn't looking that good. And, some people are comparing this to the COVID crash, and we could get this just straight down and then straight back up, and then we're in a bull market. So yeah, I mean, we just have to play the wait and see game here, guys. To try to predict this perfectly is just good luck. You're not going to. I'm sorry. Looking at the weekly, sorry, I know it's a lot here. Looking at the weekly, we could see a couple things here. We see our anchored VWAP from the August lows with the Japanese trade crisis. We see that, we broke through those pretty handedly, and then we wicked right back up to above them, right? So we wicked down again, and then we actually closed right at the bottom band. But not just that, but we broke through the weekly 50 moving average, 50-week moving average. We broke through that, and now we came back and we perfectly retested and then wicked off of that. And that is actually very bearish to come down, break down, come back, wick off of it. And then if we get obviously a continuation candle to the downside on our this week coming up, that is going to be very, very bearish, guys, because that means we broke down the 50, we retested the 50, confirmed the breakdown, and then we're going to fall down to the next set of anchored VWAPs and all the way down to 440 to 455. And that's going to be very bearish, obviously, because that's another massive about 7-8% move on the QQQ. And honestly, if we break down to that, we are looking at an overall correction of almost 20%. And this is going to be the line in the sand. We also have some volume shelf here playing in our favor. But so this is going to be the line in the sand. If we we most likely come down, bounce here, and if we break through this 100-week moving average, then we're actually in a bear market 100%, and we're going all the way down to the 200-day moving average of 377-ish. Like I said, 400 max pain. Looking at this now a little deeper, it'd actually be down to probably bottoming out around 365, I would say, to 380 would be your bottoming area on the 200-day moving average, looking at the weekly. And again, we're down here in bearish territory on our Williams percentage range. Having a little snapback here could be a bigger snapback and really take us back into the bullish channel, or it could just be a retest of the bullish channel and a retest of the 50-week moving average, and then a continuation lower, and then building our bearish Williams consolidation box. And as long as we stay in that, we're going to continue lower down to max pain, recession, bear market, whatever you want to label it as, but it would not be good at all. So I'm not going to look at the daily. I like looking at longer term time frames on this stuff. Looking at the SPY, it's a different story, and we're singing to a different tune here on the SPY. So we have our bullish uptrend, right? And we are actually higher. We are higher up on the bullish uptrend compared to the QQQ, where we are literally at the bottom, and we broke through the bottom of that bullish uptrend. So here on the monthly on the SPY, we're actually kind of like at the middle ground, and we bounce off the middle ground here. And that's to be expected, right? The QQQ will outpace the SPY by a massive margin when we're in bull markets, because it's only 100 of the biggest growth companies and tech companies in the United States. And the SPY is obviously 500 companies, the 500 best United States companies, from everything from oil to retail to tech to everything, right? So obviously it's much more spread out with 500 companies than 100 companies, and it's just much more diversified, meaning that when you get big bull runs, the QQQ at 100 different really growthy stocks is going to go way higher, way faster than the SPY with 500 diversified stocks that maybe, all the retail and like the safety plays aren't doing as good during the last bull market because all the tech companies and all of them are really carrying the SPY. But that's where it inverses, and the valuation plays, the dividend plays, all of those do really well in recessions and other bad environments, like correction environments like this, because a lot of those can help support and keep up at least a little bit the SPY, right? So the SPY is a better indicator for overall if we are going into a recession or a bear market. It's a better overall indicator because of those facts. If those 500 companies are going down big time and really, SPY is just getting crushed down, well, that shows you a better full picture of the United States and like going into a recession or a bear market because of that. But just the QQQ, which is much more riskier, much more high growth, right? So it moves faster to the high side, meaning it moves faster to the downside. So right now, the SPY is actually looking a lot better overall and saying, this is just a correction. That's what this is telling me right now. Why? Because you see the last bull run we were in before 2022, bear market, right? In the Williams consolidation box, then we broke down, we retested, and then we really went into this bear market here from 2022 beginning all the way to the bottom in October 2022 before we rebounded and started our ascent higher. So with that said, you see that we're still in our Williams consolidation box right now. We weren't a little bit ago. We were down here, but again, we wicked back up and into it and kind of, regained all of that. But again, if we look back in history, this would be the same candle as this, the one we're on right now, if we're doing a 2022 comparison. And so if we're doing a 2022 comparison, we wicked off the high five monthly indicator, right? And when we wicked off of it, people felt safe, right? And obviously we stayed within the Williams consolidation box barely. That's kind of where we're at right now, right? So we're kind of right here, wicking back higher and still in the Williams consolidation box. If we drag this down to the actual low here, you see that we are in the Williams consolidation box. Let me get rid of that. So we're still in the Williams consolidation box. We're still technically in a bull market, but it's basically the same size bull market as it was back here. So there to there, if we copy paste this, we have the same size bull market essentially as we did there. About 25,693, 25,693. It went a little bit higher to 27,346. So a little bit higher, but that just shows you that we extended actually a little bit more in this bull market than the last bull market. And that is also a bearish sign that this could be coming to an end and we need a good bear market and big pullback. And the big pullback would be first down here to this last basically support zone of 521-ish to 492-ish. And then the big crash bear market would lead us down here to these previous bull market highs and then previous bull market retests of the highs before breaking through those. So that is your range of about 440 to about 460-ish would be your range there. And obviously that's going to be a big move down of about 27% from top to bottom. And from where we are right now, it'd be another 21%. So max pain there, everybody. That's bear market, that's full on probably recession, and that's just like really, really bad times for about average bear market lasts about 10 months. Um, they in history they've have lasted up to, year and a half, 2 years sometimes, depending on how bad. So yeah, it's it's a wait and see game, everybody. Like we have our we I have my indicators that will tell me when things are getting really bad. And, if we stay up here for this month and stay in the Williams consolidation box, I'm not going to be screaming my head off and burying my head in the sand and selling all my stocks or anything like that, right? Because we're still in the Williams consolidation box. And we've been here before. We've been down here before in October 2023. And this time we were like all the way down here to the bottom of the channel. This time we're not at the bottom of the channel. We're at the middle of the channel, right? And we're right here at the bottom of the Williams consolidation box. So all that being said is I see that we built some support here and we were actually, wicked underneath it or broke down underneath it, then wicked back up, and we were back at that support area. So we're just consolidating right here. We're off the highs by a decent bit, but in my mind, if you just look at it on a monthly chart, we're just kind of consolidating right here. And so it's really going to depend on what happens next with the economy, with tariffs, with everything, right? With growth rates, GDP, all of it. It's really just going to depend on those things and whether or not we go into recession. But I will say this from what the Fed said, I'm more bullish now because of what the Fed said, because he basically said that quantitative tightening is basically dead, and that is good for the overall markets. And the Fed basically said, I'm Superman. I'm going to hold these markets up. He didn't say that with his words, but he said that with his with what his words actually mean, and what he's actually talking about. Basically saying that with these markets, he's just going to basically judge what's going on, and if inflation starts ticking up, then he's going to take action against that. But he used the word transitory, and he talked about basically tariffs being transitory and them not looking into that and into inflation and stuff. But I personally think inflation's dead. And with tariffs, it could make things tick back up, but again, I believe that it would be short term. It's a one-time thing. It's not like this, like what inflation was before when we had the bear market in 2022. So what I'm really getting at here is that he is saying that if unemployment starts ticking up and that starts getting really bad, or things start to crack in the economy, he's going to swoop in there, be Superman, and basically do what he needs to do. Cut rates, start pumping money, that money printer again into the markets, start buying stock themselves. All those kind of things that kind of leverage up and hold up the economy and hold up the stock market and help with that, right? So having the Fed on your side is a very, very good thing, where yes, you had the Fed on your side during 2022, but it wasn't on the side of the stock market. It was on the side of the economy. Inflation was running out of control, and they needed to raise rates to stop the inflation from running even more out of control and stop all the people in the US from having to pay exuberant prices for much longer than they did. So he was on our side, but in a different way. He wasn't on the stock market side. He was on the side of the economy and the small people and everybody that has to deal with inflation. This time, what he's saying is he's on the side of the stock market because he's willing to cut rates. He has the power to cut rates fast, and starting to cut rates would obviously lead to, as long as there's no big cracks in the economy, in the banking system, housing, whatever, as long as there's no big cracks that they can't fix with cutting rates pretty quickly, then obviously, Wall Street's going to be very bullish about the rate cutting, and then we would most likely see this green dot instead of this red dot. So again, we're kind of at this consolidation period on the SPY, and that is a better indicator of the overall markets and being in a bear market, bull market, etc. And yeah, still in the Williams consolidation box for now. And I actually do think this next week or so is going to start, we're going to start seeing things, bounce. It could be a dead cat bounce, like people say, or it could be the real deal and, the correction's over. And the difference between the QQQ and the SPY on the weekly chart is this fact right here. On the QQQ, on the weekly chart, we broke below the 50-week moving average, and then we retested and wicked off, right? But also these two wicks here are very bullish as well, meaning like bears forced down, bulls fought back. Bears forced down, bulls fought back. On the SPY, though, we saw the bears push down, and then the bulls fought back with this wick, reclaimed the 50-week moving average, and then essentially closed above the 50-week moving average, which is very, very bullish to not get a close beneath the 50-day moving average. Now, of course, this could just be a retest as the same. And then again, if we go down, if we have a bearish candle next week, then I think this is, I think this is the writing on the walls. Like, if we have a bearish candle next week and we engulf this week's candle, all the work the bulls did this week with FOMC, then I think, the chances of recession, bear market, etc., go way up, because then essentially you're coming down here. You are getting close to passing the smoothing line here. You're well out of the Williams consolidation box, and you're below the 50 line on this bullish channel. So for all those reasons, this next week or two is actually very, very important to understand on that balancing beam. If we are going to be falling off the balancing beam, going into a bear market, recession, not just a correction, 20% plus down, or, we got our footing today, we got our good balance shoes on today, we're going to balance across this balancing beam, a little wobbly at times, but we're going to balance across the balancing beam, get across the other side, and we are going to make it out and essentially not go into a bear market just yet. We're going to go back to the high side, maybe have another blow off top, come up to this green dot, and then at that point, having that blow off top, then I'd be way more concerned, as then, the bull market has been getting very extended at that point. So have another blow off top, and then maybe finally that bear market crash, etc. So that's the charts. That's the overall markets that I'm looking at. I know that was long, but I wanted to be thorough, and I know a lot of you out there appreciate that those thorough thoughts about the technical analysis and everything I'm seeing on that and my reasoning behind it. So I really hope that that helped you. Looking at the VIX real quick on a daily, this is also very bullish in my opinion, as every time we've had these big VIX spikes back here in August, here for the DeepSeek crisis thing, and then now here for the tariffs, you see what happens. We just completely die, right? And fall off a cliff. And essentially, next thing you know, we're back down here in our range of 1950 to 1569. So, or sorry, the range, like the bullish range is like 1148 for calm markets, up to about, I would say, 17, 18, somewhere in there. So, we did double top. We do have twin peaks right here, and we have crashed rather hard. Bullish coming or bearish coming down. Everything's looking like the VIX is going to continue down. We've had peak uncertainty, peak fear, peak everything, over these last couple weeks, months. And yeah, I just feel like VIX will continue to come down. And that's what's going to, bring a little bit of certainty back in the markets. And then the markets start moving higher from there. The dollar is coming down a lot from where it was. And, there's speculations on whether Trump wants a strong dollar or a weak dollar. They're saying they want a strong dollar. But last Last time they were in office, they wanted a weak dollar, and this time they're saying they want a strong dollar. Well, you know, a weak dollar right now for where we're at with all the debt that we have to refinance and everything, and just where things are right now is actually very good for the overall markets and the economy for right now. And then we can have a strong dollar later once we get the debt thing figured out and those issues fixed. But that's coming down. More importantly, oh my gosh, I got a lot going on here. Sorry, guys. More importantly, we got the 2-year just absolutely falling off a cliff, which is really good. We want the 2-year, we want the 2 and the 10 and the 20. We want them all to keep falling. Why do we want them to keep falling? We want them to keep falling because mortgage rates and car loans are still sky high right now. And you've had this stalling out of the housing market and the automobile purchasing market for about a year or two so far. And with that stalling out, you have people not moving, not selling their homes. Again, not moving because they're not selling their homes to move because they're locked in at like a 2.5, 3, 4% mortgage interest rate on their home, or not buying a new car because they have a good interest rate on their car. And you see where I'm getting at here. If you have that, you have less incentive to move, to upgrade to that bigger house because you know it's going to be way more expensive and usually too expensive. So the 2-year, the 10-year, the 20-year all falling is going to do what? It's going to bring down those mortgage rates from the 7s where we were, and even got to the 8s, down to where we are right now, about 6s. And it's going to bring those down to 5s and then eventually 4s, and then we'll see from there. But obviously, people will be way more interested in getting a new car or buying a new home if these mortgage rates get down and the yields keep falling and they get down to a nice, more reasonable area of 5s, 4s, because then points can be bought down as well when you're going to buy a home, and just be more bullish for the overall housing economy and, you know, the car industry and people buying vehicles. So this would be very good for the overall economy and growth as well, because what's going to happen there is if, you know, these yields continue to fall down, right? And people have less mortgages to pay. If they have less mortgages to pay because they're paying less interest because they got a better interest rate due to yields falling down and they're not paying a 7% anymore, or they go from a 2.5 or 3 and then they move and then they get a 4 or 5. Okay, they're gonna have to pay some more, and then other people are gonna have to pay less. But I'd probably say a lot. It'd probably balance out pretty much. But at the same time, I just think coming down and paying less, there's going to be more money in their pockets in the you know, regular person's, the working day person's pocket, and that's more money to spend in the economy instead of going towards interest to a bank, right? So U.S. consumers going to spend, and if they have more money to spend, basically lower car payments, lower mortgage payments, you know, they're going to spend it in the economy. They're going to spend it on who? They're going to spend it on Amazon, Netflix, Meta. They're going to spend it on these big dogs that overall, you know, prop up the SPY and the QQQ. And if they have better earnings, then so on and so forth, you know where this is going. We're going to continue higher in this bull market. So it all plays into this big old bubble and cycle of, you know, where the economy is going. It all matters. There's so many intricate details of it. And the yields coming down is very, very important. So again, you know, since 2022, you know, when we had the bear market, you saw that these yields, just the 2-year, just kind of skyrocketed. And then it kind of leveled out here for the bull run, right, over the last few years. And now it's topping out. And again, we cannot have it go up. We cannot have it go up. If these start going up, then we're 1000% going back into this bear market, 100%. We need these to go down, which you have a high, a lower high, a lower high here, a lower low, a lower low, and then we need this to obviously come down and form a lower low, break this 200-day moving average, right? So we broke the 100-day moving average, we retested the 100-day moving average here, and then we need to keep falling now on the 2-year. It's the same thing on the 10-year. We actually have this double top. We are actually right at the 100-day moving average, weekly moving average, and we need to break that as well and come down here to the 200-week moving average, and the 20-year as well, right at the 100-week moving average, and we need to come down here to 200-week moving average. If we can do that, then like I said, mortgage rates are going to come down, and everything's going to start looking a lot more rosier in the economy, especially in the housing industry and the automobile industry. Put to call ratio it came down a lot, which is good. So we got up, we spiked here and here, and this is like once we get above this line, we're very high in puts. So all these are puts, more puts than calls. And we basically spiked up, not as high as in the past, obviously, but we spiked up pretty good. And now we're back at a good, nice medium level here, where we're kind of in the middle, and that's good. That's what we want. Looking at Bitcoin, bouncing off its 50-day moving average and moving up, we would need to see it go through the 25-week moving average, reclaim that for us to believe that, hey, we're back on the bullish trail and we're good to go, just like we did here. Right, we wicked off the 50 here, wicked out the 50 here, reclaimed the 25-week moving average here, and then continued higher. So that's what we need to see from Bitcoin to see that continue to go. Now, some trades that I'm looking at here on the weekly chart, we have CVX. People are saying drill baby drill, and CVX is going to basically do very good with that sentiment. So starting to form a Williams consolidation box up here. Honestly, we're just breaking out of this right now, and you have a measured move of 30% higher. So this could go all the way up to about $210-ish for a 30% move. So here's the thing. If you wanted to get in this trade right here, right now, I think it's a good trade to get into. You just have to understand that we're running into the red barrier. The red barrier is, as you see scrolling all the way back, is whenever the Williams percentage range hits this red barrier, we are going to get consolidation, 1, or 2, we are going to get a pullback. And if we get a pullback, then obviously we're going to be getting a pullback probably down to the high 5 indicator, or back down to the breakout of the symmetrical triangle pattern, as you see. And if we just draw an anchored volume profile, you see that, this has just been consolidation for a long time now, and this breakout is very significant. This breakout was on volume, and this breakout is breaking out of all this consolidation. So I'm probably going to look to take a long-term position in CVX this week, but I'm going to go down to the daily chart, and I'm going to look for a better entry. So you see, you can draw the same thing here. Let me get a line. You can draw the same thing here, that you have this trend line. You couldn't break over it. You finally broke over it. But not only did you break over it, but you actually wicked. You broke over it, and then you came down and you wicked off it twice. So in this, you broke over, went up, came back, hit the line again, stayed above it, closed above it, came down, wicked off it again, then closed above it here. So basically, it's breaking out. The one thing, and this is just increasing volume. If I start a position here, I'm going to start a light position, only for the simple fact that we have 1, 2, 3, 4, 5, 6, 7 green days in a row. That's a lot. That's a lot of green days in a row. And if we just scroll back, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9 green days in a row. And besides that, we'd have to go all the way back to here during 2022, whenever it spiked higher. So With all that, basically I'm telling you, if we look at the daily chart, we're getting a bit extended on the green. I would probably start a 1/3 position here, and I'd look for a red day or pullback or something back to this and actual close underneath. Or I just look for us to peel off of this red barrier up here, peel off of that, come back and kind of create our base, our support for our Williams consolidation box, and then we'll continue higher as our box continues to, our Williams consolidation box continues to thrive. As long as we don't break out of it, as long as we don't roll over to red on the high 5 indicator, we're going to be peachy perfect, good to go, and we'll continue to the upside up to our measured move of $210 per share. This is a weekly chart, so it will take a little bit longer to get there. We're talking months, not weeks. Sometimes things do move pretty fast though, and they can get there within a month to measured moves. But you got to know what you're talking about. You're talking about a $290 billion company here in CVX. It's an energy minerals. It's an oil company. I would be shocked if this got to its measured move within a month. So just let you know, it'd be a longer term trade, but we are breaking out over consolidation since 2022. We're breaking almost into all-time highs here. So this one does look really good. It's on my radar. I just want to see it peel off this a little bit, have a red day, have a pullback, but more than likely, I'm going to enter 1/3 position here, another 1/3 if we get the pullback, and then another last 1/3 position once we get confirmation of that bounce of the pullback, and then we reclaim over this high. So basically making sure that I'm not rushing in anything, making sure this isn't a false breakout, right? Because essentially if we come back here and then I add my second 2/3, my cost basis will be here. Well, if this all fails and we go down here and we get stopped out, it's going to be a lot better of a stop out, and I'll lose less money because I waited and was patient to make sure this was real and confirming. Love, which is Southwest Airlines here, we had this inverse head and shoulders. We are above the 100, the 25, and the 50 week moving averages, but we are smacking smack dab into the 200 week moving average. Now, this isn't a bad thing, because what they want to do, if you want Southwest as an investor or a trader, you want to take this trade, you want to see them reclaim this 200 week moving average, and you want to see them reclaim it, retest it, and then continue higher. So I'm not looking to get into this trade right now, because the last 2 weeks we've ran 9.30. We ran like almost 20% in the last 2 weeks. That's quite a move. And you see, we're smacking right into the high. We're smacking right into the red barrier up here. So that is a lot, right? So we're smacking right into the red barrier up here. I don't like that. I rather wait for a pullback down here to this trend line and then us to reattack that, or let it go over the 200, let it come back, retest the 200 week moving average, give you confirmation, then enter to the high side. Because if they actually reclaim this 200 week moving average, which they failed to do back here, if they actually reclaim it, then you see the types of moves that this could have, right? Once it went under, once it reclaimed it, went higher, reclaimed it, retested it, it kept going and going and going. And this is back in 2013, right? And then you had this huge bull move that literally went from $6 all the way to 50 some dollars. So these are the kind of moves you can get if you just are patient and you time these things right, and you just, have them on your watch list. Next up, Celsius stock. Celsius looks really good. We had this basically sorry. We had this brains fried. This is a long video. We have this falling wedge pattern. We broke out over the falling wedge. We retested the falling wedge, and now we are continuing higher. If we engulf these two wick highs, then we're definitely going to continue higher to 38, and then our measured move of this falling wedge pattern of $49. And you see we also have a bullish Williams percentage range, and we have just made our bullish cross on our high 5 indicator which it's been a bearish cross and has been down, down, down since June, obviously. And the last time we got this bullish cross here, and we went from 53 all the way up to our top of about $100 per share. And we got the bullish cross back here, and we went from $30 all the way up to $70. So you see, when we get these bullish crosses, typically, you know, some really good things happen. So you're not too late on Celsius. We have increasing volume here. They had, you know, it's a turnaround play, and, you know, honestly, the fundamentals look pretty good if they can just get back to semi-growth like they had back in here. So that's another one. I would honestly, you can get in with a small position, but I would say, you know, wait for some sort of a pullback, just because, again, with this one, you broke out, you came back, retested, and now you've been up, and away by a large margin. And usually when you run this hard, this fast, just like you saw here, it ran real hard with earnings and then it shot back down. It's running really hard right now, and it could shoot back down. So you just need to be careful with this one. Next up, we're talking about Melly, which is basically Amazon for what is it? Amazon for they cover, I don't want to get it wrong. They cover Argentina, Brazil, Chile, Colombia, Costa Rica, Dominican Republic. You know, they're Amazon for all those countries down there, right? So they're looking very bullish. We have this massive cup with a handle, not just with the handle. We have the breakout of the handle. We have the current retest of the handle, and we are bouncing off that handle while we also have the bullish cross on the high 5 indicator. We look very bullish here, and we look like we are going to continue higher off this bounce and confirmation of the handle, of the cup and handle pattern. And the measured move of that cup and handle is 3,542. We're currently at 2,095. And then our other price target would be 3,000, just because that's a big psychological number. You see, we're in an uptrend. We had a big push. We had a big pullback down to the 50 line. We need to stay above the negative 50 line to stay bullish here. If we don't, then we could definitely roll over. This could be a lower high, and then we could come down here, back down into the 100 week moving average and 200 week moving average. But overall, you're above all weekly moving averages, and you see, you're just continuing to uptrend higher. That's really what this is. You're just continuing to uptrend higher, and things are looking really good here. I do want to look at this on the monthly. This may be a really good investment opportunity. Yeah. I mean, I would have liked to get into it back here with this bullish cross on the monthly at 1,000 and be at the 2,000, doubling my money. But you see, we just continue to make higher lows, higher highs, and we're just in a nice bullish uptrend. So, oops, that's not a good one. This is a nice bullish uptrend here too on the monthly. And yeah, you could definitely ride this higher until it stops as well. So if you want to really play it for like an investment or something, you can use the monthly or just a really long time horizon. But also, yeah, look at this. You have the cup and handle on the monthly as well. You did break out of it, and you are kind of you broke out, you retested, you wicked off that, so you're getting confirmation. So yeah, this thing looks like it wants to go to 3,000 from 2,000, which would be a very, very nice gain on your money. So there we have it. It's already a long video, so we'll call it here. Just real quick to go over Octa, cup and handle pattern, getting close to reclaiming that 200 week moving average. And if it does that, then it's up and away to 139, 186. Warner Brothers Studios. Yep. Warner Brothers Discovery. Sorry, I forgot they changed their name. They added Discovery. Cup and handle pattern here as well. And they could be launching up to 1510 here soon if they break over $12.70. That would take them back most likely to their 200 week moving average. And then the measured move of this cup and handle for them is 1879. Zscaler, cup and handle pattern. They're at the lower ends of it, but they are above all weekly moving averages. They do need to get things going here. and start making an ascent higher, but obviously you need the markets to do that. And you see the profit targets here that you could hit if we get a breakout over 264. And then finally, Palantir, very, very strong name here. The Williams percentage range is in a downtrend, but it could have one more move down to here to retest this again, or it could be curling. You see we went down below and then wicked up back above, came down, retested this again, this previous resistance, previous support now, and we kept wicking up above it. And now it looks like Palantir might want to make a run back at all-time highs, and then higher, right? I do know that more than likely a lot of government spending is going to shift their way. People are scared about government spending getting taken away from them. Well, that's not the case because they want their technology in the government. So yeah, that is a beast of a video. Again, if you guys appreciate these videos, if you like this type of content, like, follow, subscribe. I'll continue to put this stuff out for free. I appreciate you all. My voice is going already. And I hope you have a great weekend. I hope this really helps you in preparing for the week ahead. And again, I hope that you stay sane during this volatile time and craziness in the markets. It's going to be okay. If we do get a bear market, just understand, have some cash, have more inflow of cash than outflow with expenses, and you'll just be fine. You'll be able to continuously dollar cost average into the most amazing companies, tech companies, whatever it is, amazing companies in the world, and you'll be able to continue to grow your net worth, because overall the stock market will continue to go up in the end. So hope you have a great weekend. Hope you have a great week ahead. I appreciate you tuning in. If you made it to the end of the video, you're a beast. I love you. Have a great weekend. I'll talk to you guys. See you in the next one.